We're still positive on the markets, as we do think that global growth, and particularly US growth, remains solid. Inflation is decelerating. It will mean that the Fed will cut interest rates. And as the Fed is cutting interest rates, more central banks globally will also cut interest rates and follow the lead. And that overall still gives quite an inducive market environment for bonds and for equities. But of course, the devil's always in the detail. Trump policies, particularly for Asia, could be harmful also for growth. I think the good news is, and it's very different to 16, everything is on the table. We know it's a 60%. It's probably 10% for European equities. The big question is, will he and when will he implement that? And there's probably scenarios where he could also stagger basically the 60%, give room for negotiations and maybe find a deal before we actually reach at 60%. And all that could actually be a positive for Asia. So overall, we're cautiously optimistic. We know their policies are coming, but this time it's much more transparent, and we probably have to expect them earlier. But then also the market can deal with it. Valuation is cheap in Asia. Growth is holding up. Inflation is coming down. So overall, still positive.
Yeah, Adrian, your UBS chairman saying that US tariffs will significantly affect Chinese growth, but China can perhaps remediate the impact. How are you looking at that specifically?
Well, we clearly have seen the indication of and the willingness to do stimulus to also, which we haven't seen for the probably last 1.5 or 2 years, to really look after the property market. And I think that's really this sector that China has to look after. As long as we have falling real estate prices, we get so much negative feedback loop for consumers because 80% of their wealth is locked up in real estate. So addressing some of the core issues structurally but also cyclically is really very important. And I think we are much closer to that, and we see that local government getting more support for bond issuance, for example. And we actually do expect more policies if there's a harmful trade war starting out of the US. And therefore, we do think that growth can hold up. Valuation is cheap. We're not extremely optimistic for the China's market, but we actually do see some upside, and particularly some of the sectors which could benefit from more stimulus, and some of the other sectors which are more AI related that actually see quite nice upside from here.
Got it. Adrian, you're talking about whether or not the China stimulus package can reflate the economy. I think the big question over here is, can China avoid a debt deflation spiral?
It definitely has the tools to do so. National government debt is still low. They could leverage the economy much more. For me, it's more the question is the willingness. So far, we haven't seen that because they want to address the structural issues. And that probably needs longer-term adjustments. But if they have to, if they really see that particular trade war would jeopardize the growth targets that they set up, would lead to more defaults that we actually would see, and the economy and also basically the banks can absorb, they could stimulate more aggressively and more targeted.